Welcome to The Debate. Today we are analyzing Altria Group. This is the massive 100% U.S. domiciled tobacco manufacturer behind the Marlboro brand. We are looking at a business model built on repeat consumable purchases by a famously price inelastic customer base, operating in an industry that is quite literally designed to structurally decline.
Right, and our discussion today is grounded entirely in a comprehensive financial and natural language processing close read report, page 1. This source material covers a 22-year data panel, recent SEC filings, and machine learning screening results, page 1, to give us a highly empirical, unvarnished look under the hood of Altria's operations. We aren't just looking at standard financial metrics here, we are looking at how management talks, how algorithms score their accounting, and what the footnotes actually reveal. Exactly. And the central question we are debating today is this. Is Altria's exceptional cash generation and asset-light pricing power proof of a durable, widely misunderstood compounder? Or do the recent breakdown in operating margins, a massive debt load that management barely acknowledges, and a structural opacity in their public filings signal an impaired business on the brink of a terminal regime shift? I will argue that Altria's near 100% free cash flow conversion, its massive return on invested capital, and a 16.9% margin of safety, page 3, prove it is a highly resilient business whose negative equity is simply a harmless accounting artifact. And my position is quite the opposite. I argue that the historical pricing over volume mechanism is actively breaking down at the operating income line. When you combine that failure with severe sensitivity to interest rates and the deliberate legal strategy of total narrative opacity, it exposes Altria not as a compounder, but as a fragile duration trap.
Let's lay out our positions fully. And I'll start us off by looking at the core economic engine. To truly understand Altria, you have to look at its structurally cash-generative model. This is an extraordinarily asset-light business with near-zero capital reinvestment requirements. We are talking about capital expenditures as a percentage of revenue sitting under 1%, specifically around 0.73%, page 4. Because they don't have to constantly pour cash back into physical manufacturing facilities or massive research and development for their combustible products, their operational metrics are practically pristine. Free cash flow margin actually expanded from roughly 35.3% in fiscal 2022 to nearly 42.9% in fiscal 2023, page 5. And their return on invested capital, or ROIC, sits at a massive 40 to 42%, page 5.
Of the business trajectory.
Let me just finish the thought on valuation, because it ties directly into how we interpret those numbers. I know the machine learning model in our source material gives Altria a persistent reject score, page 6, but we have to contextualize why. The model is trained on standard corporate templates, and Altria has a negative $5.06 billion in book equity, page 6. A typical algorithm sees that and immediately assumes operational distress, but that negative equity is an out-of-distribution artifact. It is the result of decades of aggressive, shareholder-friendly stock buybacks, dividend payouts, and the massive impairment charge from the catastrophic Juul acquisition, page 7. It isn't a sign that the underlying business is failing.
In fact, if we use the Penman residual income model, which is incredibly useful here because it focuses on residual income rather than standard discounted cash flows, it shows an intrinsic value of $118.29 billion against a market cap of just over $101.16 billion, page 8. That gives us a 16.9% margin of safety, page 8, even if we assume zero perpetual growth.
You make a compelling case for the surface-level metrics, but hold on. You can't just look at cash flow margins and declare victory while ignoring the structural deterioration underneath. Have you considered that the vaunted pricing over volume mechanism is actively breaking down? For years, Altria's entire thesis rested on a simple formula: raise prices to offset the secular volume declines of smokers quitting or shifting to other products. While the gross margins still look fine, the reality of the business is revealed at the operating income line. Operating income year over year turned negative starting in the first quarter of fiscal 2023, dropping 4.4%, and it has stayed negative through the first quarter of fiscal 2024 at minus 3.0%, page 11. That is a fundamental regime shift.
A few quarters of negative operating income doesn't necessarily dictate a regime shift, though.
It does when it is tied to the debt and the macro environment. We have to talk about the massive, unnarrated debt load. Long-term debt sits at roughly $25.04 billion, page 12. They are taking on higher coupon issuances in a higher rate environment. We're seeing rates of 6.2% for a 2028 maturity and 6.875% for 2033, page 12. This creates extreme valuation fragility. You mentioned the Penman model's margin of safety. Well, a mere 1% increase in the weighted average cost of capital from 6.91% to 7.91% completely eliminates your margin of safety, page 14. It drops the intrinsic value right down to $100.6 billion, page 14. And capping it all off is a catastrophic lack of disclosure. The natural language processing algorithms in our source material found 0 extractable management claims in the fiscal 2024 10K MD&A. They have a candor score of 3 out of 10, P15, and a dividend payout ratio well over 100%, with absolutely no disclosed sustainability framework.
Okay, there is a lot to unpack there, so let's move into a more direct cross-examination and take this piece by piece. I want to dive into your first major criticism regarding the breakdown of operating leverage. I completely understand why seeing operating income turn negative for a few quarters sets off alarm bells. But my first question to you is this. Revenue contracted 3.5% in fiscal 2022, but that narrowed to just a 2.4% decline in fiscal 2023, while gross margin expanded by 150 basis points to 58.3%, page 16. How can you claim the core engine is broken when the gross unit economics are visibly expanding?
Because gross margin ignores the reality of fixed cost absorption. That leads directly to my first question for you. Let's look closely at the second quarter of fiscal 2023. SG&A, selling, general, and administrative expenses, spiked by $291 million, a massive 52% increase, which drove operating income down 6.4% year over year, page 17. If price increases can no longer offset fixed cost absorption and SG&A growth, isn't the compounding narrative fundamentally broken?
I don't believe it is, because that was largely an anomaly regarding absorption and transition investments. If you look at it on a net revenue basis, stripping out excise taxes, operating margins are actually in the high 50s and show a modest improvement trend, page 18. So my second question to you shifts to the balance sheet. You are terrified of the debt, but Altria boasts an 11.6 times interest coverage ratio and a net debt to free cash flow of 1.63 times, page 19. In what world is a debt profile with an 11 times coverage ratio considered a crisis?
It becomes a crisis when you trace the hidden debt narrative. The footnotes show the debt carrying value surged from $6.2 billion in 2014 to $13.9 billion in 2017 to fund Juul, which management never adequately narrated, page 20. My second question is about capital allocation. The NLP analysis scores their capital allocation discipline at the 0th percentile, page 21. How do you underwrite a business perpetually refinancing $25 billion amidst structural mid-single-digit volume declines without a formalized capital allocation framework? That is our first explicit investigation gap, understanding how they actually plan to allocate capital over the next decade.
I underwrite it because